Imagine a company where, their core legacy product has just totally collapsed, like by 72% over the last decade.
Right, which is huge.
Yeah, the sheer volume of what they traditionally sold is basically gone, vanished.
You'd think they were heading straight for bankruptcy.
Exactly. You would think we're about to discuss a Chapter 11 filing, executive scrambling, the stock, and a death spiral. Just a classic cautionary tale for business school.
But it's not.
No. Instead, the company we're looking at today just posted the highest profit margins in its entire corporate history.
It's wild. It completely defies, I guess, the standard narrative we always hear about technological disruption.
Totally.
Because we're so conditioned to see the old guard just get completely swept away by new technology, leaving nothing behind but like a Wikipedia page.
We see it all the time. I mean, Blockbuster failing to adapt to streaming, or Kodak inventing the digital camera and then just burying it until they went broke.
Right, the classic examples.
It's practically a law of financial physics, right? When your main product dies, your company goes down with it.
Which is exactly why this particular situation is such a fascinating outlier. I mean, it requires a complete reevaluation of how we look at legacy businesses.
Absolutely. So welcome to this deep dive. Today, we're taking a special extended Talk Tickers approach to the data.
Yes, we are.
If you're a regular listener and familiar with our Talk Tickers format, we usually prioritize data forward, jargon free, and highly actionable takeaways.
Got to keep it actionable.
Exactly. So we're applying that exact same rigorous, opinionated lens today, but we're giving it the full deep dive treatment.
And we've got a lot of data to get through.
We really do. We are going to extract the signal from the noise of the Q2 2026 earnings call for Donnelley Financial Solutions. That's trading under the ticker DFIN.
DFIN, yep. And, to really grasp the signal here, you have to understand the origin story of this company.
You really do.
Because you can't appreciate the margins they're posting today without understanding the massive physical footprint they evolved from.
So let's establish that context for everyone listening. DFIN wasn't always a standalone entity, right?
Yeah.
They were spun off about 10 years ago, back in 2016, from R.R. Donnelley.
Right. And R.R. Donnelley was a behemoth.
A judge.
Giant. Yeah, we were talking about one of the largest commercial printers in the entire world. I mean, they printed telephone books, magazines, catalogs, and crucially for our discussion today, financial documents.
And financial printing was this highly specialized, intensely physical business.
Oh, intensely physical.
If we rewind to the 1990s or say early 2000s, when a company wanted to go public or file a massive annual report with the SEC, the process was incredibly labor intensive.
It really was. You would literally have investment bankers, corporate lawyers, and executives all sitting in R.R. Donnelley conference rooms at like 2 a.m.
Eating stale pizza.
Yeah, eating terrible pizza, just looking over physical, freshly printed proofs of an S1 registration statement.
With red pens.
Literally with red pens, making manual corrections on paper.
And once those corrections were made, the printing presses downstairs would fire up. I mean, they would put tens of thousands of these massive, heavy prospectuses.
Just mountains of bank.
Load them onto pallets, put them on trucks, and physically mail them out to shareholders and institutions all over the country.
And that was the legacy of DFIN. A business model heavily reliant on physical logistics.
Right.
Massive printing presses, warehouses full of paper, and just armies of personnel to manage the distribution.
Very capital intensive.
Highly physical, capital intensive, and completely vulnerable to the digitization of the financial system.
So cut to today. You have a company that is still tasked with that exact same overarching mission, right?
Yeah.
Helping public companies meet their regulatory disclosure requirements.
Same mission, totally different execution.
Right. Because they're doing it in a world where physical paper is rapidly becoming obsolete. So they are split right down the middle. On one side, you still have the remnants of that legacy print and distribution business facing these massive secular headwinds.
Dying a slow death, basically.
Yeah. And on the other side, you have their modern, cloud-based compliance software segment.
Right. Products like ActiveDisclosure and Venue.
Which we'll get into.
Yeah, these are sleek, AI-driven software as a service platforms. They handle those same complex regulatory requirements, but they do it entirely digitally.
And the tension between those two realities is crazy. Managing the controlled demolition of the physical print business while desperately scaling the digital cloud business.
That's the tightrope they're walking.
It's what makes this specific quarter so incredibly revealing. So we're going to break down the headline numbers, and I want to warn you, The contrast between the top line and the bottom line is going to smack you right in the face.
Okay, let's unpack this. The top line revenue is always the most logical starting point for an earnings breakdown.
So let's look at the core data delivery for Q2. Net sales came in at $224.2 million.
Okay.
Now, that is a year-over-year increase, but it is a very modest 2.8% increase.
Yeah, and for a retail investor scanning a screener for high-growth tech stocks, 2.8% top-line growth doesn't even register.
No, it looks completely stagnant.
Right, it looks like a mature company just barely keeping pace with inflation.
But if you stop your analysis at the revenue line, you miss the entire story.
Yeah.
Because then we look at the profit.
This is where it gets good.
Specifically, adjusted EBITDA, which came in at $82.3 million. That represents a 7.9% increase year over year.
What's fascinating here is that for anyone new to parsing these specific financial metrics, EBITDA stands for earnings before interest, taxes, depreciation, and amortization.
Right, just a very clean metric.
Exactly. It's a clean, standardized way to measure a company's core operating profitability. It strips out the accounting artifacts and the capital structure, to just show you how much cash the actual business operations are generating.
And their operating profit is growing almost 3 times faster than their revenue.
3 times?
That is the first massive clue that something structural is happening underneath the hood.
It suggests significant operational leverage. I mean, they are generating more profit from every incremental dollar of sales.
Which brings us to the absolute stunner of the quarter. The adjusted EBITDA margin hit 36.7%.
Wow.
Yeah, that is a record quarterly high for the company. They expanded their margins by 170 basis points year over year.
And when we talk about basis points, just a quick reminder, 100 basis points equals 1%. So they expanded their profit margin by 1.7 percentage points.
That's huge.
It is. Achieving a nearly 37% operating margin for a business that, let's remember, still manages a significant physical printing and logistics operation is just a monumental achievement.
Let me try to put this into a framework that makes sense if you aren't, modeling income statements all day.
Please do.
I was thinking about this transition. And it's kind of like trading in a gas guzzler for an EV. Or actually, let's use a restaurant analogy.
Okay, I like restaurants.
Imagine you own a massive, traditional, full-service dining establishment. You have a huge waitstaff, hosts, bussers, a massive kitchen.
Sounds expensive.
Very. And you are pulling in $10,000 a night in revenue, but your payroll and food waste are so high that you only keep $1,000 in actual profit. You have a 10% margin.
A very standard, slightly painful scenario in the hospitality industry.
So you realize the model is breaking. You decide to transition the business into a highly automated, self-serve buffet model.
Okay, pivoting.
Right. You cut the waitstaff by 80%. You streamline the kitchen. Because it's a buffet, maybe people pay a little less per head, or you lose a few of the high-end diners. So your overall revenue drops to $8,000 a night.
So revenue is down.
Yes. And if Wall Street is just looking at your top line, they see your sales fell from 10K to 8K and they panic.
But the cost structure has fundamentally changed.
Exactly. Your labor costs have plummeted. So on that $8,000 of revenue, you are now keeping $3,000 in pure profit. Your revenue went down, but your cash in the bank tripled. Your margin expanded massively.
And that is exactly what we are seeing in these numbers for DFIN. The top speed of the company isn't increasing dramatically.
The revenue?
Right, the revenue. But the fuel efficiency, the margin, is off the charts.
It's a great position to be in.
It is. And what is crucial for an investor to understand is that a 36.7% margin doesn't happen by accident.
No. Definitely not.
You don't just stumble into record profitability while your legacy product line is deteriorating. This is the result of a deliberate, multi-year, and quite frankly, ruthless strategic shift by the management team.
We definitely need to explore the mechanics of that shift. I mean, how do you actually expand margins that aggressively?
Well, CFO David Gardella mentioned cost management multiple times during the call.
He hammered on it.
He really did. They are utilizing AI to drive productivity, they are reducing third-party spend, and they are ruthlessly optimizing their headcount.
The phrase that kept coming up in the commentary was that they have variabilized their print requirements.
Yes.
I think this is a vital concept. When you manage a shrinking legacy business, the biggest risk is getting trapped under the weight of your own fixed costs.
Oh, absolutely. Like still paying the lease on a massive printing facility even when you only have half the volume to run through it?
Precisely. Fixed costs remain the same regardless of your production volume. If your volume drops, the fixed cost per unit skyrockets and your profit margins just evaporate.
They vanish.
So DFI made the strategic decision to shed those fixed costs. CEO Dan Leib noted that they now only operate one main internal facility with a limited set of digital printing assets.
Wait, just one facility? So what happens when a massive order comes in that exceeds the capacity of that one facility?
They outsource it.
Oh, okay.
They have established a vast, flexible network of third-party commercial printers. Instead of owning the machines, paying for the maintenance, and employing the unionized print workers directly, they just route the jobs to external partners on an as-needed basis.
And that is what variabilizing means. The cost of printing only exists when a paying client places an order.
It perfectly protects their downside. As the overall volume of financial printing inevitably drops year over year, DFIN doesn't have to worry about idle factories dragging down their earnings.
They just route fewer jobs to the external network.
Exactly. They take their margin on the project management and the compliance expertise rather than the physical ink on paper.
It is a phenomenal way to manage a declining asset. You squeeze every last drop of cash out of it without taking on the structural risk.
Yeah.
And we can see the results of that strategy in their cash flow statement. Their free cash flow for the quarter was $61.2 million.
Which is great.
That's an increase of $9.5 million compared to the same period last year.
And free cash flow is the ultimate truth teller in corporate finance.
I'll say. You can massage earnings through accounting adjustments, you can capitalize certain expenses, but free cash flow tells you exactly how much actual cash entered the business, cash that can be used to pay dividends, pay down debt, or buy back stock.
And speaking of debt, this might be my favorite data point from the entire quarter. Let's talk about their balance sheet.
Let's do it.
Their non-GAAP net leverage ratio is sitting at 0.7x.
That is an incredibly low number.
For context, they have total debt of $204 million. But when you subtract the cash they have on hand, their net debt is only $178.7 million.
Right.
So a 0.7x leverage ratio means their net debt is only equivalent to about 8 months of their annualized earnings.
Consider why this matters in the current macroeconomic environment. We are operating in a world where interest rates have been aggressively hiked.
Very aggressively.
The cost of capital is higher than it has been in decades. Companies that gorged on cheap debt over the last 10 years are now facing a massive wall of refinancing at punishingly high rates.
It is choking a lot of mid-cap companies. The interest payments alone are eating up their free cash flow.
But DFIN is practically immune to that pressure. A ratio under 1.0x is remarkably clean, especially for a company that was spun out of a much older, larger corporate structure.
That's a great point.
Usually when a spin-off occurs, the parent company saddles the new entity with a significant amount of the legacy debt. It's basically standard practice.
But DFIN has spent the last decade systematically cleaning that up.
They have.
Yeah.
And having a 0.7x leverage ratio gives management total optionality. If the economy tips into a severe recession and capital markets freeze completely, DFIN has the fortress balance sheet to survive a prolonged drought.
Right.
If they spot a strategic acquisition target that can accelerate their software development, they can easily secure financing. Or, as we will discuss a bit later, they have the freedom to aggressively buy back their own stock.
So we have established the narrative tension. The top-line revenue barely moved, growing less than 3%. Yet profits surged, free cash flow is up nearly $10 million, margins hit an all-time record, and the balance sheet is basically bulletproof.
That's a great setup.
The obvious question for an investor is, what exactly is selling so incredibly well to drive this level of efficiency, and what is the anchor that is dragging the total revenue down?
Well, we need to look under the hood of that 2.8% growth and isolate the different segments of the business. Because that blended rate hides the true momentum.
Yeah, the biggest story, and frankly the entire thesis for holding this stock, is the software boom.
Absolutely.
The software solutions segment hit a record $99.4 million in Q2. That represents 7.8% growth year over year.
And this brings us to the most critical metric for anyone attempting to model DFIN's future earnings potential. Software now constitutes 44.3% of their total sales.
Almost half the company.
Almost half. And that is up 200 basis points from just 1 year ago. The composition of the company's revenue is shifting rapidly.
And within that software segment, we have to talk about the star player on the field, ActiveDisclosure.
ActiveDisclosure is their flagship cloud-based financial disclosure management software. And to really understand its value, you have to understand the burden of being a publicly traded company.
Right.
You don't just get to operate your business, you have to constantly report your financial health to the Securities and Exchange Commission.
Yeah, you have the 10K, which is the massive annual report. You have the 10Q, which is the quarterly report. You have 8Ks, which report any major material events that happen between quarters.
And building those documents is an intensely collaborative and high-stakes process. You have the internal corporate finance team, the accounting department, the legal team, external auditors, and sometimes outside counsel all needing to review, edit, and approve the document before it is filed.
And doing that over email with version control issues is a recipe for a disastrous compliance error. Final v3.doc, right?
Oh yeah, an absolute nightmare. ActiveDisclosure solves that. It provides a secure, cloud-based platform where all those different stakeholders can collaborate in real time, maintain perfect version control, and ultimately push the final document directly to the SEC's EDR system.
And the market is clearly validating the product. I mean, ActiveDisclosure didn't just grow, it surged. It grew a massive 29% year over year in the quarter.
29% is huge.
Furthermore, management noted in the transcript that this is the fourth consecutive quarter where the platform has exceeded 20% growth.
And sustaining 20+% growth for a full year inside a mature 10-year-old enterprise, that is exceptional.
It really is.
It proves they aren't just relying on legacy relationships. They have achieved genuine product market fit and are executing aggressively on their sales strategy.
So what is the specific catalyst driving that adoption? The CEO, Dan Leib, pointed to a few different factors, but the one that stood out the most involves AI-driven capabilities, specifically related to something called IXBRL tagging.
Okay, IXBRL is one of those incredibly mundane, highly technical regulatory requirements that quietly dictates the workflow of thousands of corporate finance departments.
Boy.
It stands for Inline Extensible Business Reporting Language.
I challenge anyone to say that 3 times fast. It sounds like a terrible Wi-Fi password.
It's a dense acronym for sure, but the concept is revolutionary for financial analysis. Let's break down why the SEC mandates it. In the old days, a company would file a 10K as basically a giant text document or a static PDF.
Human readable, but entirely useless to a computer.
Right. So if an analyst at a hedge fund wanted to compare the gross margins of 50 different tech companies, they would have to hire a team of junior analysts to literally read through 50 different PDFs, find the specific revenue and cost of goods sold numbers, and manually type them into a spreadsheet.
Wow, incredibly inefficient.
Soul-crushing work, honestly.
Yeah.
So the SEC introduced XBRL and later the inline version, IXBRL. It is a standardized digital format that mandates that every single numerical fact in a financial filing must be embedded with a hidden machine-readable data tag.
So wait, when I look at the document on my screen and I see net revenue, $100 million, it looks like normal text to me.
Right.
But a computer program scraping that document sees a specific code, a tag, that tells it exactly what that number represents according to standard US GAAP accounting principles.
Exactly. It allows algorithms, screeners, and analysts to instantly parse, aggregate, and compare financial data across the entire stock market in milliseconds. It completely democratized financial analysis.
Okay, that sounds fantastic for the analysts. But what about the company that actually has to file the document?
Oh, for the filing company, it is an absolute nightmare.
I bet.
Imagine a 200-page annual report. There might be thousands of numbers in the tables and the footnotes. Someone has to go through and manually apply the correct accounting tag from the SEC's vast taxonomy to every single number.
If you tab your net income with the code for operating revenue, you have just filed materially misleading information with the SEC.
Exactly.
The liability is huge.
It requires intense scrutiny, usually from highly paid accountants. It is tedious, miserable work that is incredibly prone to human error.
And this is exactly where DFIN software steps in and provides massive value. They're deploying artificial intelligence, specifically natural language processing models, to automate the tagging process.
Yep. The AI can scan the text surrounding the number, understand the context of the financial table, and accurately predict which specific IXBRL tag needs to be applied. It takes the heavy lifting completely off the shoulders of the corporate finance team.
I can see why a CFO would sign off on that software subscription in a heartbeat. You are saving your accounting team hundreds of hours of frustrating work, reducing the risk of a regulatory filing error, and streamlining those final days before the earnings release.
It is the ultimate take the pain away enterprise software pitch.
Right.
It drives new client acquisition, but more importantly, it allows DFIN to increase the average revenue per user. Clients are more than willing to pay a premium for the AI-driven automation.
It's a great product narrative. But the software growth isn't just happening in a vacuum. It is heavily influenced by the broader macroeconomic environment, which brings us to the second major driver of the quarter, the capital markets rebound.
The broader environment for corporate transactions has been incredibly challenging recently.
Yeah, if you look at the last 2 years, the initial public offering market and the mergers and acquisitions market have been basically frozen solid.
We had aggressive interest rate hikes from the Federal Reserve, significant geopolitical tensions, and just general macroeconomic uncertainty.
Right.
If you were a CEO considering taking your company public, you looked at that environment and decided to wait. The cost of capital was too high and market valuations were too depressed.
But the Q2 data from DFIN shows a serious thaw in that ice. Their transactional net sales spiked 36% to $47.3 million.
And transactional revenue is highly sensitive to market activity. When we talk about transactional sales for DFIN, we are primarily talking about two things: companies going public and companies engaging in mergers and acquisitions.
To put that in plain language, a company goes public by filing an S-1 registration statement with the SEC. It is a massive, complex document that outlines the entire business model, the risks, and the financial history of the company.
And when a company decides to file that S-1, they inevitably need a partner to help them build it, secure it, and file it.
CFO Dave Gardella dropped a statistic on the call that really highlights their dominance in this space. He mentioned that DFIN captured approximately 50% of the market share for IPOs over $100 million during the quarter.
50%. Capturing half of the major IPO market is a testament to the institutional trust they have built over decades.
I like to think of DFI as a toll booth on the highway of capital markets. You can't really execute a major public transaction without driving through their infrastructure.
That's a great way to put it.
If you want to merge with another company, or if you want to take your company public, the very first thing you need is a highly secure, encrypted environment to share highly confidential documents with lawyers, bankers, and auditors during the due diligence phase.
You absolutely cannot just use a standard commercial cloud drive for that level of sensitive intellectual property. You need a purpose-built virtual data room.
And that is DFIN's Venue software platform.
Venue generated $37.5 million in revenue this quarter. Now, that was only up 1% year over year, which might sound slightly underwhelming given the 36% spike in overall transactional revenue.
Yeah, it seems like a mismatch.
But management provided important context. They were overlapping a remarkably large single project from the second quarter of the previous year.
Gotcha. And if you look at the sequential growth comparing Q1 of this year to Q2 of this year, Venue was actually up 14%. The momentum is clearly building as deal-making resumes.
The real power of their product suite is how interconnected it is. The life cycle of a deal flows directly through their software ecosystem.
Walk us through that life cycle. How do Venue and ActiveDisclosure connect?
Sure. Let's use an IPO as an example. The process starts months before the public ever hears about the deal. The private company opens a Venue virtual data room.
Okay.
They upload all their historical financials, their material contracts, their employee data. The investment bankers and the external auditors log in, review everything, and conduct their due diligence.
So Venue captures the early stage revenue of the transaction.
Right. Then, once the due diligence is complete and they are ready to actually draft the public S-1 filing, the team migrates over to ActiveDisclosure. They use the collaborative tools and the AI tagging we just discussed to build the final document.
And this was explicitly confirmed in the earnings call. Gardella noted that roughly 1/3 of ActiveDisclosure's massive 29% growth this quarter came purely from higher utilization tied to the creation and filing of S-1 documents for IPOs.
The capital markets rebound serves as a powerful catalyst for their software sales. The more deals that happen, the more virtual data rooms they open, and the more software subscriptions they sell.
The interconnected ecosystem is clearly working. But every ecosystem has its decay, and that brings us to the segment that is dragging down the top-line numbers. We have to talk about the print division.
Ah, yes, the legacy anchor.
Print and distribution revenue fell 15% in the quarter, dropping to $34.6 million. And Dan Leib provided a historical statistic during his commentary that is just staggering to comprehend. He noted that print revenue has collapsed 72% since DFIN was spun off 10 years ago.
72%. Yeah. To put real numbers to that percentage, they went from generating roughly $385 million in print revenue a decade ago down to about $108 million over a trailing 12-month basis today.
Experiencing a 72% decline in a core business line over a decade is a traumatic event for a corporation.
Oh, usually fatal.
Yeah, it destroys cash flow, it forces massive layoffs, and it requires intense, flawless management focus just to survive the transition without going bankrupt.
Which makes their record 36.7% profit margin even more impressive. They haven't just survived the decline, they have engineered a way to thrive during it.
Okay, here is where I want to push back a little bit on the narrative.
Okay, let's hear it.
I need to play devil's advocate for a moment because something in this transition math feels a bit counterintuitive to me. If DFIN's traditional full-service compliance business, where they essentially acted as a high-end concierge, doing all the formatting, the project management, and the physical printing for the client, if that was their historical bread and butter, isn't migrating those exact same clients over to a self-serve software platform like ActiveDisclosure just cannibalizing their own revenue?
Well, yes.
I mean, are they just trading a high-paying, full-service client for a lower-paying software subscription?
That is the essential existential question for any company attempting a legacy to SaaS transformation. Adobe faced this when they transitioned from selling physical software boxes to the Creative Cloud. Microsoft faced it transitioning to Office 365.
And the answer is?
The short answer is yes, absolutely. They are cannibalizing their own revenue.
So if they are intentionally shrinking their own top line, why is Wall Street cheering? Why does the stock price respond positively to cannibalization?
Because it is incredibly, immensely profitable cannibalization. This is the secret sauce of DFIN's current valuation strategy. We need to look at the gross margin differential between the two models.
Let's run the math on that. I laid out the restaurant buffet analogy earlier. How does that translate into actual dollars and cents for DFIN?
Okay, let's use a hypothetical compliance project. When a client uses DFIN's traditional full-service offering, the top-line revenue number that DFIN can report to Wall Street is higher. They charge the client for the skilled labor of the project managers, the typesetting, and the massive cost of physical printing and distribution. Let's say it's a $100,000 invoice.
Okay, $100,000 in revenue.
But the costs associated with delivering that service are exceptionally high. DFIN has to pay for the human labor, they have to buy the physical paper, they have to pay for the ink, the postage, and the logistics. So after all those costs, maybe DFIN only keeps $20,000 in actual operating profit. That is a 20% margin.
Which is a decent margin for an industrial business, but not great for a tech company.
Correct. Now, let's look at the transition. DFIN's sales team convinces that exact same client to migrate to the ActiveDisclosure platform. The client agrees. They pay an annual software subscription. And the client's internal accounting team uses the software to do more of the document preparation themselves. Because it's a software tool rather than a concierge service, the total bill drops. Let's say the new contract is for $80,000.
Okay, from $100K to $80K. DFIN has just cannibalized $20,000 of its own top-line revenue. This is why their total sales growth was only a sluggish 2.8% this quarter. The print revenue is bleeding out faster than the software revenue can replace the absolute dollar amount.
Exactly. The top line shrinks. But look at the cost structure of the new model. Software has a near zero marginal cost of reproduction.
Meaning it costs basically nothing to add one more user to a cloud platform you've already built.
Right. There is no physical paper to buy. There is no postage. There is vastly less human labor required per client because the AI is doing the tagging and the client is doing the formatting. So on that $80,000 software contract, the gross margin isn't 20%. It might be 75% or 80%.
Let's assume an 80% margin. On an $80,000 contract, DFIN keeps $64,000 in gross profit.
Compare the two outcomes. Under the legacy model, they reported $100,000 in revenue, but only generated $20,000 in profit. Under the new model, they report only $80,000 in revenue, but they generate $64,000 in profit.
Wow.
The revenue dropped by 20%, but the actual cash entering the business more than tripled.
That dynamic is incredible. And this isn't just a hypothetical model. We can see this exact phenomenon playing out in the earnings report.
You can. This is precisely why their non-subscription software revenue grew by 69% year over year.
Non-subscription software revenue. What does that mean?
It refers to clients paying for specific one-off transactional filing activities that they execute through the software platform, rather than paying a traditional full-service invoice. The activity is migrating from the legacy service bucket into the software bucket.
CFO Dave Gardella explicitly stated this dynamic during his prepared remarks. He said that this migration produces favorable economics with slightly lower revenue, but higher adjusted EBITDA margin, which has played out so far.
There you go.
He is literally telling the market, we are sacrificing top-line revenue to acquire massive bottom-line margins.
So what is the actionable takeaway for a retail investor? It means you have to change how you evaluate this company. You cannot punish DFIN for slow, single-digit top-line growth right now. Every single dollar of legacy print revenue they lose is being replaced by a software dollar that is vastly more valuable to the bottom line.
The quality of the revenue is radically improving, even if the absolute quantity is only inching up. They are trading pennies for quarters.
And as long as they can maintain the discipline on their fixed cost keeping that print infrastructure variabilized, the margins will continue to hold strong.
With this legacy to software transition working so visibly well, and the margins expanding so aggressively, it makes me wonder what the management team sees on the horizon. Can they maintain this pace? Are there any looming threats to this momentum, or is it just blue skies and sauce multiples from here?
To answer that, we need to dive into management's forward-looking guidance and address what I would call the regulatory wildcard. The future of this company is heavily dependent on the actions of the SEC.
Let's start with what they expect for the immediate future, the Q3 guidance.
The third quarter outlook provides a very clear, sober lens into how management sees the rest of the year playing out, and it highlights the cyclical nature of their business.
They're projecting Q3 net sales to land between $175 million to $185 million. Now, if you take the midpoint of that range, $180 million, that implies about a 3% year-over-year growth rate. So it is steady as she goes on the top line. The slow, methodical growth continues.
Which perfectly aligns with the highly profitable cannibalization dynamic we just spent time dissecting.
Right. But then you look at their profitability guidance. They project EBITDA margins to cool slightly, landing between 26% and 28%.
Right.
Now, wait a minute. We just spent the first half of this deep dive celebrating a record-breaking 36.7% margin in Q2. Why are they projecting a massive 10 percentage point drop in their margin for Q3? Did the business model break?
Not at all. What you are seeing here is the profound role of seasonality in the financial compliance industry. It is a highly cyclical beast. You cannot extrapolate Q2 margins out for the entire year.
Explain the mechanics of that seasonality. Why is Q2 so special?
Q2, which covers the months of April, May, and June, is historically DFIN's largest and most profitable quarter because it perfectly aligns with what the industry calls proxy season.
For the uninitiated, what exactly is a proxy statement and why does it generate so much revenue?
Every publicly traded company is required to hold an annual shareholder meeting. At this meeting, shareholders vote on critical corporate issues, electing the board of directors, approving executive compensation packages, and ratifying the independent auditors.
Sure.
But since millions of retail investors can't physically attend a meeting in New York or Silicon Valley, the company sends them a proxy statement. It is a document that lays out everything being voted on and provides a mechanism to vote electronically or by mail.
And when do these meetings happen?
The vast majority of public companies operate on a standard calendar year ending December 31st. They spend January and February auditing their books, they file their 10K annual reports in February or March, and then they hold their annual shareholder meetings in the spring, typically May or June.
So before you can hold that meeting in May, you have to blast out millions of proxy statements and annual reports to every single person who owns even one share of your stock.
Exactly. This creates a massive localized bottleneck of regulatory activity in the second quarter. The volume of compliance services, software utilization, and print distribution skyrockets. Because the volume is so immense, DFIN achieves maximum utilization of their resources, which pushes their margins up to that 36.7% record.
They are running at absolute maximum capacity.
But once July hits and Q3 begins, the proxy season is over. It becomes a quiet period for scheduled corporate filings. There are fewer massive print runs and fewer complex annual filings.
So a projected 26% to 28% margin for Q3 isn't a failure. It is just the normal baseline operating level for the back half of the year when the seasonal volume drops off.
Correct. In fact, Gardella noted during the call that the top end of that 28% guidance is essentially flat compared to last year's Q3 performance. They're maintaining their baseline profitability.
And what about the transactional side? Are they expecting the IPO window to slam shut again?
No, they are actually quite optimistic. They expect transactional revenue to stay strong in Q3, coming in between $45 million to $50 million. At the midpoint, that is an increase of $6 million year over year.
Meaning they expect the IPO and M&A markets to remain active?
Yes. They specifically noted that the momentum they built over the last few quarters in the transactional space has continued solidly into July. Dealmakers are still utilizing Venue and ActiveDisclosure.
Okay, so the short-term guidance is solid, predictable, and accounts for the normal seasonality. But let's zoom out and talk about the long-term elephant in the room.
The regulatory wildcard.
Yeah, the SEC catalyst or the SEC risk, depending on how you view the strategy. CEO Dan Leib spent a significant portion of his prepared remarks discussing the SEC's recently proposed Regulation e-Delivery.
This was perhaps the most consequential piece of strategic news from the entire earnings call for anyone holding this stock for the long term.
I want to give the plain language translation of what Regulation e-Delivery actually is and why it matters so much. Under this proposed rule, by the year 2028, the SEC wants to make digital delivery, meaning an email or a secure web link, the absolute default method for investors to receive their mutual fund annual reports, prospectuses, and proxy statements.
To understand the impact, look at the current system. Right now, unless you, as a retail investor, proactively log into your brokerage account and actively opt in to go paperless, the regulatory default is physical mail.
Which means you get a massive phone book-sized stack of paper mailed to your house every time a mutual fund you own updates its prospectus.
I think every investor listening knows exactly what you're talking about. You get these thick, dense legal documents in the mail printed on that really thin paper.
I get them constantly, and I will be honest, they go straight from the mailbox into the recycling bin. I never open them.
Millions of them suffer the exact same fate. It is an astronomical, largely wasted cost for the mutual funds and the public companies who have to pay for the printing and the postage. And from an environmental standpoint, it is a nightmare. The SEC has finally recognized that the modern investor prefers digital access.
So if this new regulation is officially enacted, it flips the default. The new rule establishes electronic delivery as the standard. You would only get the massive paper phone book mailed to your house if you specifically call up your broker and demand physical copies.
And very few people will actually do that, which means the overall volume of physical financial mail is going to plummet overnight.
So let's tie this back to DFIN. I look at this proposed regulation and my immediate thought is, isn't this the final nail in the coffin for their legacy print division? If print volume has already fallen 72% organically over the last 10 years, a mandated SEC shift to default e-delivery by 2028 sounds like an extinction-level event for the remaining $108 million of print revenue.
It absolutely does. It is a regulatory cliff. And to his credit, CEO Dan Leib did not try to sugarcoat the reality of the situation. He explicitly stated during the call, and I quote, "We believe the proposal has the potential to materially reduce demand for printed products over time."
He acknowledged the threat directly, but he didn't sound panicked about it.
No, he didn't. He sounded prepared. This is where the long-term strategy of the company really comes into focus. DFIN is actually leaning into this regulatory cliff. They aren't lobbying aggressively to stop it. They are preparing their business model to capitalize on it.
How do you possibly capitalize on a federal agency regulating your legacy product out of existence?
Because the underlying compliance requirement doesn't disappear. It simply changes form. The SEC still fundamentally requires that the financial information be meticulously prepared, legally reviewed, securely hosted on a server, and verifiably delivered to the shareholder.
Right. The regulatory burden is still there. It just moves from ink and paper to digital pixels and email servers.
Exactly. And because DFIN has spent the last decade building a flexible operating model, they are perfectly positioned. Remember, they already variabilized their print costs. They don't have massive factories they need to liquidate. So they can smoothly manage the final wind down of the physical print revenue while simultaneously stepping in to handle the immense technical complexity of the new digital content management requirements.
They will just sell the mutual funds, the software, and the digital delivery mechanics to replace the printing presses. They capture the revenue on the other side of the transition.
And to ensure they actually capture that digital revenue and don't lose it to nimble tech startups, they made a massive strategic organizational move this quarter. They hired Ken Napolitano as their new chief revenue officer.
A newly created role for the company.
Yes, a newly created high-level executive position specifically designed to accelerate their go-to-market software strategy.
Why is a CRO so important in this specific moment?
Because selling enterprise software requires a completely different culture and strategy than selling legacy print services. You are no longer selling based on per-page print costs and logistics. You have to sell the CFO on workflow efficiency, AI automation, and digital security. You don't bring in a high-powered CRO unless you are preparing to aggressively retrain your sales force and hunt for software market share.
They know the 2028 digital cliff is coming. They can see the deadline on the calendar.
They have roughly 2 to 3 years to lock in as many mutual funds and corporate clients as possible onto the ActiveDisclosure platform and their digital distribution networks before the print revenue evaporates completely.
It's a race against the regulatory clock, but they entirely control their own destiny. They have already built the digital products. ActiveDisclosure works, Venue works. Now it is purely a matter of sales execution.
And they are actively building the corporate culture necessary to support that execution. Live mentioned during the call that DFIN was recently recognized as the #1 most loved workplace globally.
I saw that in the transcript. And I have to admit, when I read things like most loved workplace in an earnings call, it usually sounds like corporate stuff to me, just HR marketing.
It often is. But consider the context of DFIN's specific challenge. We are in a relatively tight labor market for highly specialized talent. DFIN is trying to attract top-tier software engineers, AI specialists, and aggressive enterprise sales talent.
And it is hard to attract top Silicon Valley talent to a 10-year-old financial compliance firm with a legacy printing background. It's not exactly the sexiest pitch.
Exactly. So having a verified, objectively strong corporate culture is actually a highly strategic asset for them. It lowers employee turnover, it reduces recruiting costs, and it helps them compete for the engineering talent they need to keep ActiveDisclosure's AI features ahead of the competition. It isn't just fluff, it's a structural advantage in a talent-constrained market.
Okay, we have covered a massive amount of ground. We've looked at the headline numbers, the AI software growth, the mechanics of profitable cannibalization, the seasonal guidance, and the looming SEC regulatory shift. Let's bring this all together into actionable takeaways. This is the part of our Talk Tickers format where we synthesize the data and take a definitive, opinionated stance.
Our stance on this specific Q2 earnings call is definitive. The data presents a highly bullish signal for the stock. The underlying mechanics of the business are strengthening, even if the top-line revenue isn't screaming higher.
I share that bullish sentiment. But let's break down exactly why this is actionable for you, the retail investor who is either currently holding this stock or screening it for a potential position.
It is actionable because you are witnessing the textbook execution of a legacy-to-SaaS transformation.
SaaS being software as a service, the holy grail of recurring revenue.
Yes. DFIN is proving, quarter after quarter, that they can successfully manage the decline of their old capital-intensive business without blowing up their balance sheet or collapsing their cash flow. And simultaneously, they are rapidly scaling a high-margin, sticky, recurring revenue software business inside the shell of the old company.
And the management team isn't just getting on the earnings call and asking you to blindly believe their narrative. They're literally putting their money where their mouth is. To understand how confident they are, we have to talk about their capital allocation strategy.
How a management team allocates their free cash flow is one of the strongest, most transparent indicators of their internal confidence. Words are cheap. Capital allocation is absolute.
Let's look at the numbers. In Q2, DFIN repurchased 763,000 shares of their own common stock. They spent $34.7 million in a single quarter to do it, busting those shares at an average price of $45.48 per share.
The aggressive nature of these buybacks is incredibly revealing. If you zoom out to the year-to-date numbers, they have bought back 1.4 million shares for $63 million.
And they aren't stopping. They still have $125.4 million left in their board authorization to keep buying shares on the open market.
Let's break down why share repurchases matter so much for an individual investor. It is a concept that is often misunderstood.
Give us the underlying math of a buyback. Why should I care if a company buys its own stock?
Think of a company's total equity as a pie, and that pie represents a claim on all the future profits of the business. When you buy a share of stock, you own one specific slice of that pie.
Simple enough.
Now, when the company generates free cash flow, they have choices. They could build a new factory, they could pay a cash dividend to you, or they can go into the open market and buy back slices of the pie from other investors and then permanently retire those slices.
They destroy the shares.
Yes. And when they shrink the total number of slices, the specific slice that you hold just became a mathematically larger percentage of the entire pie.
Even though I didn't invest another dime, my ownership stake in the company just increased.
Exactly. It artificially boosts the earnings per share, or EPS. Even if the company's total net income stays perfectly flat, it is a highly tax-efficient way to return value to long-term shareholders compared to a taxable dividend.
But beyond the pure math of EPS accretion, it is also a massive signaling mechanism to Wall Street.
It is the ultimate signal. It tells the market that the CEO and the board of directors, the people with access to all the internal projections, the sales pipelines, and the proprietary data, looked at their public stock price trading around $45 or $46 and concluded, our stock is fundamentally cheap.
They determined that the absolute best return on their capital right now isn't acquiring a competitor, it isn't launching a massive new marketing campaign, it is simply buying their own undervalued stock.
CFO Dave Gardella practically spelled this out during the Q&A session with analysts. He explicitly stated that they are historically more aggressive at the lower prices, less aggressive at higher prices. The fact that they are plowing tens of millions of dollars into buybacks right now at current price levels tells you exactly what the insiders think of their current valuation. They believe the market is mispricing the success of their software transition.
So the final verdict here is incredibly strong. If you are looking at DFIN, you are evaluating a company with a squeaky clean balance sheet featuring a 0.7x leverage ratio. They are practically immune to current interest rate pressures. You have a management team executing an aggressive share buyback program that provides a massive floor of support for the stock price. And you have rapidly expanding technology margins driven by AI automation and SaaS adoption.
All of those bullish factors exist right now, today.
And they exist while the company is still just waiting for the broader capital markets, major IPOs and massive M&A deals to fully, completely thaw. The transactional rebound has clearly started, as we saw with the 36% jump, but it is not even close to being back to historic normalized highs yet.
The leverage they have built into their operating model is immense. When that transactional volume fully normalizes and the IPO window swings wide open, that incremental revenue isn't going to be eaten up by heavy fixed costs. It is going to drop straight to the bottom line of a much leaner, much more profitable software-driven company.
It is a coiled spring. Okay, let's wrap this deep dive up with a final provocative thought. We always like to leave you with something forward-looking to mull over as you analyze your own portfolio.
We have spent the last hour dissecting the past execution and the present data. Let's look at the future valuation narrative.
This October, DFIN is celebrating a major milestone. It marks their 10-year anniversary as an independent public company following the spin-off from R.R. Donnelley. In a single decade, they have managed to morph from a literal physical paper pusher into a cloud-based, AI-driven compliance engine.
It is a structural transformation that most legacy companies attempt but ultimately fail to achieve.
It is incredibly rare. So here's the question you need to ask yourself as an investor. If the SEC's Regulation E delivery officially goes through and it effectively eliminates the vast majority of the legacy print division by 2028, will the broader market finally stop valuing DFIN as a boring, slow-growth legacy financial services firm?
This gets to the heart of how Wall Street assigns multiples. Legacy financial printers, industrial companies, and mature service providers generally trade at very low price-to-earnings multiples because they are viewed as stagnant, capital-intensive, or dying businesses.
The market doesn't pay a premium for a shrinking ice cube.
Exactly. Conversely, pure-play SaaS companies trade at incredibly high multiples because of the predictability of their recurring revenue, their massive gross margins, and their scalability.
So if the print anchor is finally permanently cut loose by SEC regulation in 2028, does Wall Street wake up one morning, look at DFIN's income statement, realize it is essentially generating all its profit as a pure SaaS company, and fundamentally re-rate the stock to a high multiple tech valuation?
If that psychological re-rating occurs among institutional investors, if they stop comparing DFIN to commercial printers and start comparing them to enterprise software companies, the current share price in the mid-40s could look like a massive historical bargain.
That is the multi-million-dollar question surrounding the stock. It is a compelling, data-backed narrative of legacy destruction, digital rebirth, and incredible margin expansion.
It really is a textbook case study in successful corporate evolution.
As you move forward, keep a very close eye on their ActiveDisclosure software growth numbers over the next few quarters. Ensure the 20% growth rate holds. And definitely set an alert for any news regarding how the SEC moves on the proposed Regulation E delivery timeline. That is the catalyst that could accelerate everything. This has been our extended deep dive into the DFIN Q2 earnings, applying our Talk Tickers framework to the long-form analysis. We unpack the muddy, complex waters of a legacy transition, and it turns out the water underneath is a lot clearer and significantly more profitable than it looks from the surface. Stay curious, keep analyzing the data, and we will catch you on the next deep dive.